Okay, well, let me welcome you to our webinar this morning. My name's Neil Davis, and I'm joined by my colleague, Lisa Taylor, who I should probably point out is celebrating her birthday today. So happy birthday, Lisa. We're both partners in our professional indemnity team, and I also head up the firm's cyber insurance practice. We've got about 15 minutes today for our presentation, and then there'll be time at the end for some questions. So please do post any questions you have in the Q&A box at the bottom of your screen. My colleague and senior legal advisor, Harriet Strevens, will pick them up for us at the end, and hopefully we'll have time to answer a few. But if we do run out of time, we'll deal with them separately after the session by email. I need to point out that this session is being recorded, and whilst you can see us, we and the camera cannot see you. The Cover Talk series of webinars focus on policy coverage issues, and today we're going to talk to you about the minimum terms and conditions which apply to solicitors' policies. Specifically, Lisa's going to look at the practical issues which arise for insurers from the minimum terms and possible changes on the horizon. And then I'm going to take a look at the topical issue of cyber cover in the minimum terms and the recent SRA consultation and some proposed changes. I should mention that we're not going to be dealing with aggregation today. That's something which my colleagues David Gooding and Bharti Patel covered in their Cover Talk a couple of weeks ago. And you can find that on our website, along with all of the other Cover Talks that we've done over the last 15 or 16 months. Lisa.
Thank you, Neil. Now, the majority of you will be very familiar with the minimum terms and conditions already. For those who are not familiar, the minimum terms are the SRA's mandatory terms of cover for firms authorised by the SRA, which came into effect in 2000, when Solicitors' Professional Indemnity Insurance returned to the open market from the Solicitors' Indemnity Fund, SIF. What this means is that all qualifying insurers who provide insurance for solicitors sign up to an agreement to provide a policy wording which adopts the minimum terms prescribed by the SRA. Now, I should flag that this relates to primary policy cover only up to the 3 million limit and not to excess layers. So this means that all insurers are offering on the same terms across the market. I should point out that they can be better or different wordings, but they cannot be less than the minimum terms. They are very prescriptive and impose extremely onerous obligations on insurers, and insurers cannot deviate from them except in respect of certain things. The wording is thought by many to be gold-plated in nature, the Rolls-Royce of insurance, and that means cover is broad and has to be provided no matter what, save for in respect of some limited exclusions. The primary reason for this is consumer protection, and protection of the client is really at the heart of all the SRA consultations on these issues. It is also the most stringent of any professional compulsory insurance and can mean that solicitors are often viewed as easy targets for claims. There is an awful lot I could talk about today related to the provisions of the minimum terms, but as Neil said, we have limited time. And so for today's purposes, I'm going to focus on 3 specific issues which relate to some of the financial implications. First of all, the premium, secondly, the excess, and then runoff. So payment of the premium on inception. Once the policy is in place, that means that cover is in place. And that is even the case if the premium is not subsequently paid by the insured. Therefore, insurers have to provide cover even if they haven't had the benefit of the premium. And this may not bode well for the rest of the policy period, as it may be indicative of the approach that the insured might take to other issues, such as claims cooperation generally, or payment of the excess in the event of settlement of a claim. Insurers can take enforcement action against firms who don't pay their premium, and sometimes do, but what has been called for is more consistency in relation to regulatory action against those firms who don't pay them, which may be more of a deterrent to the firms than enforcement action by the insurer. Another issue for insurers can be payment of the excess. The minimum terms provide that if an insured fails to pay to a claimant any amount within the excess within 30 days of it becoming due for payment, then the claimant can seek payment directly from insurers. Again, insurers may seek recovery from insured firms if they're still in existence, but in practice, where the excess is minimal, it doesn't often happen. Again, if the SRA were more willing to take regulatory action against those firms, there may be more of a willingness to pay it. The third issue, and one of the biggest challenges and exposures for insurers, are the run-off provisions. Run-off cover provides cover for a period of 6 years after closure of a firm, and this is mandatory required cover, and it can be expensive, but insurers are obliged to provide it, and it kicks in automatically if a firm closes during the policy period. This is long tail in nature and means that insurers are exposed to claims for up to 6 years, which is felt by many to be too long and gives rise to too much uncertainty. Run-off premiums too can be expensive, sometimes 3 times as much as the premium itself. And again, the problem for insurers is that this is triggered even when the run-off premium is not paid by the insured. So insurers still have to provide it even when they've not been paid. So there's a common theme here really about insurers having to provide cover even when they've not been paid by the insured. So what is being done to address some of these issues? Well, in 2018, the SRA looked at the runoff issue and considered reducing the period of runoff from 6 to 3 years. At the same time, it also looked at reducing the minimum limits of indemnity. It also considered capping the overall level of runoff cover at 3 million for firms that had done conveyancing and 1.5 million in relation to other firms. However, nothing changed as a result of that. Related to runoff but runoff beyond those 6 years, only last week, the SRA confirmed that SIF will remain open to new claims beyond September 2021 for a further 12 months. And that is a second extension. And this really was following concerns raised by the Law Society, consumers and the wider profession. It means that SIF will provide cover for closed firms once their mandatory 6-year runoff period has come to an end. And this further 12 months gives the SRA time to consider whether there's a regulatory place for cover after the 6-year period has expired. And it's expected that the SRA will use this time to look carefully at possible solutions to this issue, to look at possible comparable runoff arrangements and to determine what should happen after those 6 years is up. The Law Society has been critical of the SRA's approach on this issue and has asked it to work with the Law Society and the insurance industry more widely to find a long-term solution to the problem and look at identifying a possible alternative to the provision of 6-year runoff cover. So these various factors, as well as the COVID pandemic, have had a big impact on the solicitors market. The market has hardened, premiums have increased by around 30% and in some cases even more, and insurers have exited the market. And those that remain having no choice but to place increasingly stringent requirements on the firms. So higher premiums, stricter payment terms, personal guarantees, and so on. And many firms have been forced to close as a result. So what next? Well, in September 2020, after some months of unsuccessful consultation with the SRA, the International Underwriting Agency, the IUA, set out its concerns in an open letter to the profession. What it said was that the risk being taken on by insurers could become commercially unacceptable, leading to a restriction in the supply of insurance across the board. And this is really as a result of the fact that insurers have to pass these extra costs onto the law firms, really as a result of only a minority of the firms affected, but it passes on to the rest of the profession. The IUA asked the SRA to review the minimum terms. It asked for it to consider a number of changes. First of all, cancelling cover if the premium, including for runoff, was not paid. Secondly, for payment of excesses by insureds to be mandatory and deducted from claims. And third, for payment for runoff cover becoming compulsory at inception. Now, the Law Society responded to this, recognising that if the problem was not addressed, it could drive insurers from the market, reducing capacity even further, making it harder to find cover and increasing the cost. But notwithstanding the concerns raised by insurers, it points back to what it says is the primary purpose of professional indemnity insurance, which is to protect clients and the public. It therefore appears unlikely that there will be significant changes to the minimum terms along the lines lobbied for in the near future. But one area, though, where there may be some clarification is in relation to the response to cyber incidents. Lloyds and the PRA have also asked the SRA to give more clarity around cover within policies for cyber risk. And I'm going to pass you over to Neil now, who's going to look at the background to this, the SRA consultation, and what the outcome of this might be.
Thanks, Lisa. Well, it's not going to surprise any of you to learn that law firms have been and continue to be significantly exposed to cyber events. They hold a lot of data and money, and no firm is therefore immune. Cyber events can take the form of malicious acts. So, for example, a ransomware incident or infection of an IT system from malicious code. And we've seen in the last couple of weeks that Gately was the victim of a cyber attack in which client data was reportedly stolen. Cyber incidents can also take the form of non-malicious acts. So, for example, the laptop that's left on the train with personal or sensitive data on it, or an IT outage due to a non-malicious systems failure. The law firm which is the victim of a cyber event, whether malicious or non-malicious, could suffer from a range of different types of losses. In general terms, those could include first-party losses, so for example, the loss of revenue suffered by the firm while its systems are compromised, or the costs of dealing with the incident and restoring its IT systems. They can also include third-party losses, and I'm referring there to the liabilities which the firm might have to its clients, or potentially others, as a result of the incident. So, for example, a claim for damages due to a loss of sensitive personal information, or a claim arising out of a missed deadline due to an IT interruption. The current minimum terms already provide cover for third-party losses arising from a cyber event. However, they don't do so explicitly. Instead, such claims will be picked up as a result of the broad wording of the minimum terms, which provide that cover must respond in respect of any civil liability arising out of private legal practice. And that definition is extended to include the obligation to reimburse money lost from client account. That approach, adopted by the minimum terms, gives effect to the wide consumer protection that Lisa has already mentioned. It's also an example of so-called silent cyber, sometimes known as non-affirmative cyber. That's where the policy doesn't expressly make reference to cyber cover, either by including it or excluding it. But despite the fact it doesn't mention it, the policy nevertheless potentially provides at least some cover. Silent cyber's been a focus of the regulators for some time. In 2019, the Prudential Regulation Authority, which regulates insurance companies, issued a Dear CEO letter requiring insurers to develop plans to reduce their silent cyber exposure. Later, Lloyds went further and required that all policies issued by Lloyds syndicates had to provide clarity regarding cyber coverage by expressly excluding it or providing affirmative cyber cover and charging a proper premium for it. In response to these requirements, various professional regulatory bodies are reviewing how they deal with cyber exposure of their members in terms of the mandatory insurances which they require them to have. The SRA is addressing this through proposed amendments to the minimum terms, and it's recently closed a period of consultation in respect of the suggested changes which they're proposing. In short, the focus of the proposed changes is to maintain the current protection provided for all consumers, but to do so with greater clarity for insurers, law firms, and consumers alike about the scope of cover which is provided. The proposed changes to the minimum terms therefore permit a participating insurer to issue a policy which contains an exclusion in respect of first-party losses caused by a cyber incident, and that cyber incident includes a cyber attack, a failure of a computer system, the receipt or transmission of malware, or a breach of data protection law. But it contains an important caveat which states that the insurer is not permitted to exclude liability to indemnify for civil liability or related defence costs. Put more simply, the proposed changes to the minimum terms permit insurers to exclude liability for first-party losses sustained by a law firm as a result of a cyber event, but they expressly prohibit insurers from excluding liability to indemnify in respect of third-party losses from a cyber event which arises as a result of a breach of a duty in the provision of legal work. So in that sense, as currently proposed, the changes to the minimum terms do little more than seek to provide clarification to the present position. They do not and are not intended to extend in any material way the scope of cover provided by the current minimum terms. And indeed, the SRA went as far as to say that the consultation was designed to ensure that the changes do not inadvertently reduce or expand the scope of cover provided by existing PII arrangements. Although interestingly, in its response to the consultation, the Law Society said that its preferred option would be for the SRA to introduce wording that would affirm that solicitors' minimum terms compliant PII cover covers all cyber risks, including first-party losses. The outcome of the consultation remains to be seen, but I suspect that it's unlikely that it's going to lead to profound or material change to the way in which cyber incidents are dealt with by the minimum terms, and the new terms should be enforced before 1st of October this year. So despite the protections offered by the minimum terms, law firms are still going to need to consider their cyber exposure closely and will need to assess whether they need additional or complementary cover to reflect the full extent and range of losses to which they might be exposed as a result of a cyber incident. So that brings us to the end of the formal session. We've now got an opportunity for questions. So I'm going to hand back to Harriet Strevens, who's been picking up your questions from the Q&A box.
Thank you very much, Neil. There are a couple of questions, and my first, which I direct to you if I may. You mentioned the Law Society is pushing for the minimum terms to cover first-party losses. Can you see that happening?
Well, I think, like all things, never say never, but I think that would be surprising. We've talked today about the purpose of the minimum terms being primarily aimed at consumer protection. And I think to incorporate first-party losses within the minimum terms would be and represent a significant departure from that. And that would bring a host of issues which would need to be considered. So, for example, I wonder whether insurers or all participating insurers would have an appetite to write first-party losses. So that could potentially limit the number of insurers who were prepared to participate in that market. For those that did, I strongly suspect that it would lead to substantial increases in premium. And so I suspect that that would raise problems for a number of firms over whether or not they could afford that cover, if indeed it was mandatory. I think that there's also the fact that the minimum terms currently don't cover first-party losses for solicitors. So a good example of that is the trade debt exclusion, which means that those sorts of losses won't be covered. And as I say, I think that would represent a departure. And then, of course, when you're looking at a first-party loss type policy of the sort that we see in the open cyber market, a lot of what those policies provide is based around breach response capabilities, helping firms to be able to respond quickly and effectively to incidents when they occur. And they have an entire structure around them which enables firms to do that with the support of insurers and a breach response panel. So I think if you were going to introduce first-party cover into the minimum terms, you'd need to look really carefully at whether aspects such as that would need to be incorporated. And as I say, I think that would represent probably a fundamental departure from the way in which the minimum terms are currently set out, and is therefore going to be something that, if it was to happen, would require a lot more consultation.
So that being the case, what do you think that firms need to be thinking about in terms of their cyber exposure?
Well, I think all firms, this is cyber is probably the issue that should be keeping managing partners and boards of law firms up at night. And I think there are really three things which firms should be thinking about. The first is obviously their cybersecurity arrangements. Are they up to date? Have they got the latest cybersecurity in place? Is it fit for purpose, adequate for the job? Does it provide the protection that's needed? The second aspect is probably making sure that people within the organization are well trained. So it's still the case that a significant proportion of cyber incidents are the result of, or at the very least could have been avoided, but for human error. So that's individuals clicking on the wrong link or opening an email from a bogus source. So law firms should all be concentrating on making sure that their staff right throughout the organization are well versed in the threat posed by cyber incidents and take steps to train and make sure that people work accordingly. And then, of course, there's insurance. The minimum terms, as we've just talked about, will provide a level of cover, will provide that protection in the event of third-party claims. But it's really important that firms think about whether that is going to be sufficient for their purposes. In the event of a significant incident, are those firms going to have the ability to recover themselves, to get back online, to get trading again? And would they benefit from some form of cover that would help them to do that? Each firm needs to weigh up its own requirements, but I think that the relevance of insurance for cyber-related risks has never been greater, and all law firms should be working closely with their insurance brokers to understand exactly what their needs are and what's available to meet those needs.
So finally this morning, because we are running out of time, what about premiums? Do you expect to see them going up as a result of changes to the MTCs relating to cyber, and how that might affect the pricing out of smaller firms?
Well, I'm not sure that I do, because, and in fact, the SRA has been quite clear about that in its consultation, that it doesn't see premiums destined to go up, because what the changes are doing is providing clarification of the existing position, and as proposed, not intending to expand the scope of cover. I think the clear steer from the SRA is that premiums shouldn't go up. Now, of course, we've already heard from Lisa that there's been a hardening of the market and premiums are going up generally. So it wouldn't surprise me to see that trend continue, but the extent to which they do so as a result of a change to the minimum terms, I think, is likely to be minimal.
So, Lisa, do you think we'll see changes to the MTCs in the near future or not, given the past experience?
I think it's really difficult, Harriet, because there have been a number of SRA consultations and proposals, but very little by way of outcomes. And I think the IUA letter, the open letter, was sent following unsuccessful discussions with the SRA to really highlight what the issues are and the challenges faced by insurers. But I think it's just going back again to what I mentioned at the beginning, which is what is at the heart of the minimum terms from the SRA and the Law Society's perspective is protection of the public and the consumer. So my view is that there's unlikely to be any sweeping changes anytime soon.
Thank you very much indeed, both of you. We do have a number of questions on the chat, but we'll have to deal with those afterwards if we may by email. And I'll now pass back to Lisa to close up.
Thank you. Thank you very much for joining us. Please do complete the feedback form, which will be on your screens when we sign off, including the part about how you would like us to present these sessions going forward, i.e. whether that's in person, online, or a hybrid approach. Feel free also to include any topics you would like us to consider speaking about. Our next session will be on Thursday, the 8th of July, when Andrew Tobin will be speaking about political violence and insurance. Andrew has a huge depth of knowledge and expertise advising the market. He's written a book about it too, and he's going to look at the issues relating to this very interesting area. But for now, thank you very much for joining us, and have a good rest of the day.